Hello, everyone, and welcome back to Learning to Trade with Tony. And today's today's lesson, we're going to get into options trading and swing trading. Now, the method of swing trading that I'm a fan of is options trading. I, you, People have asked me if I trade options, and on a day trading basis, it's not my go-to position. But certainly from a swing trading basis, this is where options really add value. I believe they add value. Okay, I find it a lower risk way of being in the market for a longer period of time. Reduced exposure again. So it's highlighting what we've been talking about in every single lesson pretty much to this point. Um, what is fundamentally the single most important principle of trading is risk management. Okay, finding ways to reduce our risk. As traders, we do know that trading is risky. Options are absolutely still one of the most risky financial instruments that you can trade. But on the other hand, they can be used as a way of gaining leverage. Okay, so that will allow you to generate a lot more profits with less capital at risk. So if we have the likely potential to take, I don't know, 50% loss on our losers, our winners can also be 100, 200% winners. It's not something that I would ever consider using a strategy to put the majority of my capital in. Options can be very volatile, but we look for volatility in the markets, and this is a financial instrument that we can use to help us reduce our exposure. Okay, so options trading it's complicated. Anyone that's brand new to trading is going to be confused by some of the terms that I'm going to use in this lesson. Okay, it's going to seem a little backwards at first, maybe. And that's okay. That's okay. Just take it one step at a time. If you have to watch the class again, no problem. Watch it again. Watch it a couple of times. If you need to do some research outside of the class just to understand some of the terminology, that's okay too. If you need to email me directly, if you have questions, that's okay as well. So, just give me send me a mail, send me a message. Let me know if you have questions, and it's okay. It's to the uninitiated around options. It does take a little while to get used to the terminology. It can be a little confusing. Okay, but don't let it put you off because they are a great way of a great addition to your portfolio of strategies to trade. Okay, now let's go to the first slide here. What are options? Well, options are derivatives. So Tony, that's nice, but what are derivatives? Okay, well, what I mean by that is that the value of an option is based on the value of something else. Okay, so options, they're a contract. They give you the ability or they give you the right to buy or sell a stock. They give you the option to buy or sell a stock, hence the name. So you're purchasing the right or the option to buy or sell a stock at a fixed price before a fixed date. So you're not actually buying the stock itself. You're simply buying the option or the ability to buy a stock at a later time. Okay. Now, that later date is called the expiration. So, the expiration date, if you will. So, you have up until the expiration date to exercise your option. Now, exercising your option is when you say, okay, I want to go ahead and get those shares that I have this contract for. Okay, I've got a fixed price, and the fixed price is also called the strike price. So when we look at an options chain, which is basically where all the options potential combinations are listed. We're going to look by expiration date first. So we're going to look at options that are expiring at the end of this month, or the end of next month, or the month after that. Okay. We're going to look at the various strike prices. So those are the prices that we can buy the options contracts for. Okay. So, a stock that's trading at $500 is going to have a strike price of $500. It might have another at 505 or 510, 515, 520, etc. And increments of $5. Other stocks have strike prices in increments of $1. Some are in increments of 50 cents. I think there are a few other increments as well, depending on the size, the underlying stock that it's referencing, and the price of the underlying stock that it's referencing is it depends on the stock price as to what the incremental price. It's all relative. Okay. So the price that you pay for this options contract is called the premium. Now, the value of the option is based on the value of the underlying asset, the stock. So the option by itself is just a contract, and the contract of its all of its value is going to be based on the value of the underlying asset, the stock. So that's why they're called derivatives. They by themselves don't have their value. Their value comes from something else. Okay. I'm trying not to make it too complicated or sound too complicated. So just bear with me. Okay. Let's take a step back with that in mind. And for a second, I'll do this example. Now, an example of an options contract could be that I'm going to give you the option to buy a house. I'm going to give you the option to buy it for $500,000. Okay. So $500,000, that's your strike price. And that option, that contract I'm going to give you is going to expire on December 31st. So I'm giving you the ability to buy this house. You don't have to. It's not an obligation. It's only an option. Okay. But with this option, you'll have the right to buy this house for $500,000 anytime up to December the 31st. And for this option, you're going to pay a premium of, let's say, $1,000. Okay, the $1,000, that's going to be the cost of your options contract. So if this house is worth 501,000 or more, you'll be at profit, right? Anything above 501, and you can start selling for a profit. Okay, so you could also decide to sell that options contract on the open market to anyone that's interested in buying it. So say you're in the money on the options contract, but you don't want to exercise it. You don't want to actually buy the house itself. We'll say the house is now worth more. You can go ahead and sell it to someone that's interested in it. So that's where we find the market and the level two. We have a level two for options, and it's the buyers and the sellers of options lining up. Okay, so you don't have to exercise options. You can buy them and then resell them. And that's what most options traders do. They're just buying them and reselling them. They're not actually exercising the options contract themselves. But when you buy options, you have the right to go ahead and buy that stock at a later date at that given price. Or you have the right to sell that stock at a later date, to short the position, if you will. Okay? So as a buyer, we have rights. But as a seller of options, and this is also called writing options, writing a contract, if you write the options, you're writing that contract. As me, in this example, as the owner of the house, giving you that contract, I have the obligation to sell you the house for $500,000. I now am obliged to do that. I have no option. I have to do it, okay? But you have the right, if you don't want to, you don't have to. But I have to. So selling options or writing options is more risky, right? You have an obligation, but when you're buying them and trading them, you have rights. So it's a safer position to be in. So let's say in this scenario, for example, scenario number one. Let's say this house is now worthless, okay? So you paid $1,000 for this options contract, and we've just found out that my house is haunted. So it's worth $250,000 to someone that wants to live in a haunted house. But it's not worth the $500,000 anymore, right? So now you still have the options to go ahead, and you still have the option contract. You still have the option and the right to buy my house by December 31st for $500,000. But you're not going to do that. Why would you do that? It's only worth 250,000 now. Okay. So that $1,000 option contract that you bought, it's basically worthless, right? It is worthless. You could sell it to someone on the open market for maybe a penny, but that's it. You're going to lose 100% of the money that you put in. Okay. But when you paid that $1,000, it gave you control. It gave you leverage. It gave you the potential to buy a $500,000 house. So with that little option contract that was only worth $1,000, you had leverage and you had control of something much bigger. Okay, and that's why people really like options. They allow you to leverage small amounts of money. Okay, so you know the risk there is that because of the change in the underlying asset value, your option contract can drastically decrease in value to the point where it's worthless. Most options contracts expire worthless. Okay. Now, scenario number two. Let's just say that the house was built with solid gold. Someone thought it was a really good idea, a really good construction material. Okay, they didn't use bricks, and instead they just used bars of gold. I'd call them stupid, but that's besides the point. So that house is actually worth $5 million. It's a very small house. Okay, now you can still execute this options contract before December 31st to buy the house for only $500,000. Now, me as a seller of the options contract, I'm going to be kicking myself. I'm going to have bruises up and down my shins because, it's a horrible deal. But now I'm obligated to fulfill my end of the deal. I have to sell you this house for 500,000. Now, you could go ahead and buy the house for $500,000, but let's say all you had in your investment account was $2,000. You put 1,000 on this options contract, so now you have the right to buy the house for 500,000, but you don't have that kind of cash. So what do? Well, you sell it to someone who wants it. So again, we go onto the open market. We've got our level twos, and now you sell it to the buyer that wants to buy that options contract. And this options contract that you bought for $1,000, right, is now worth, let's say, $4.5 million. Okay, so this is just an example. This is granted, it's a really drastic example. Now, where do I get $4.5 million from? Because the contract is worth the appreciation of the underlying stock, less the strike price. So your strike price was 500,000. So you had the ability to buy at 500,000. You paid 1,000 for the contract. You had the ability to buy at 500,000. It's now worth 5 million. Okay, so the increased value of that contract now is 4.5 million. Okay, because the house is the underlying asset, the house, is now worth 5 million. less the original strike price. So it's 4.5 million. Okay. So, like I say, it's a drastic example, but it's to give you an idea of how option contracts can drastically increase in value. Okay. Or conversely, they can expire worthless. But it's all depending on the value of the underlying asset. Okay. Now, there are a few. There's this is a simple example, but there are a few things, a few factors that come into play when determining the value of an options contract. And I'm going to go over some Greek terms. And I know a lot of people, when they don't understand something, they might come out and say, that's all Greek to me. It's a popular expression. But these terms are terms that apply specifically to the in the world of options. Okay. And these Greek terms are commonly used. It's theta, vega, and delta. Okay. So theta, that's referring to time decay. That's the amount of time between when you purchase the options contract and its expiration date. Okay, so when you have a lot of time between the purchase and the expiration date, there's more value. There's more intrinsic value there, right? You've got a lot of time for something to happen, either the house to become worthless or become worth a lot. So there's value in time. Okay, but as time goes on, we're going to lose money in time decay. Okay, now vega is volatility. Now, some assets are going to be much more volatile than others. So, the house is going to be appraised, or there's some maybe pending structural issue that's going to increase. It's going to increase the vega or the volatility. Okay. And then lastly, delta. That's the rate of change versus the change of the underlying asset. So if you got an options contract to, let's say, buy the house for $1 million, and the value at present time is only 500,000, your option is really, really far away from the current value. So any little fluctuation in price between, say 500,000, 520, 480, that kind of thing, it's going to have very little effect on the $1 million strike price. What I'm saying is that the further away you get from the current trading value, the lower your delta will be. Okay. And in the money or at the money is right at the point of value. That's going to have the highest levels of delta, because these small fluctuations are going to make a much bigger difference when you're talking about a strike price of, say, 500, 510, 520. Okay, so that's going to be much more reactive. Now, we're talking about time decay. The more time you have until the expiration, the more value there is in that contract. Okay, so the way that I trade when I'm looking at options contracts is that I look at usually weekly or monthly. I don't tend to look for contracts that are several months out, because my trading style is much more short term. So if we get options that are really far out in terms of expiration, we're going to be paying a much higher premium, right? That the cost of that premium is going to be higher, and we don't want to pay that high premium, because we're not getting in these for long-term trades. We're looking for short-term moves. So we don't want to pay the extra money for that value. So instead, we're going to look for contracts that expire sooner, because they're going to be cheaper. Okay, so every day that passes, you're going to see the value. Uh, the, you're going to see the value. It decreases just a little bit more, and a little bit more, and a little bit more. There's a weekly options that on Friday they're going to expire. Friday when the market closes. So Friday morning they might be valued at $2, and by the afternoon when we only have a couple of hours left in the market, the stock price can be flat, and you watch the option just ticking down in value. It's just losing value. So on one hand, you think, well, I should short that, right? Because it's probably going to expire worthless. And this is one of the areas where you can really get into a lot of problems. You can get into a lot of risk because, well, in theory, yes, there's a good chance that they will expire worthless. Um, if there's a sudden spike in the price, you know, coming into the end of the day, the level of risk is almost unlimited, right? Shorting stocks is risky. Shorting options is even riskier, right? A spike in a buyout, for example, you could be really, really underwater before you know it. So instead of playing time decay strategies when you're shorting options, waiting for them to expire worthless, there are traders that use that strategy, granted, and there are ways that they can hedge themselves against the risk of something crazy happening, but it's more complex. So you know something you can research if you're curious about it, maybe, but it's not a strategy that I use. And it's not something I recommend because of the risk. Going back to what I keep saying about mitigating the risk rather than taking on additional risk. Um, so that's time decay anyway. Okay. Now with volatility in the market or in the sector will be priced into the value of the option, right? So we notice this especially right around earnings season. So let's say a stock like Netflix that is getting ready to report earnings, typically a stock might have options that are in the thousands of dollars. Okay, they might be $1,000 for the option near the money. Okay, so maybe there are $1,000 when we have the options expiry. Okay, and then the earnings, the value of those options will be much higher. So they're actually pricing in the anticipated volatility that's about to come in the market. Okay, so the next day, let's say the earnings are a non-event, and we close at 350. We open the next day at 350, and all of a sudden, those options are going to plummet in value. Right, the day before whatever price they were, the next day they're going to be a fraction of that price because all of a sudden that volatility that was expected, it didn't happen. It's gone, right? So all the value that you had there the day before is now gone. So there's a strategy of trading options called straddles and strangles. Okay, and I've mentioned this on my lives about strangleholds and straddles and strangles. When you're doing a straddle or a strangle, what you're doing, you're buying, but you're basically buying both sides of the trade. You're buying it's like going long and short at the same time. Okay, you're buying a put and a call. Okay, so that's the terminology. Okay, and the idea is that because you're paying a premium, so let's go back to the house analogy. Okay, on one hand you have the option to buy the house for $500,000. Okay, so in the option where you're buying the house for $500,000, you're hoping the house is going to skyrocket, and it's going to go up to $1 million and beyond, and you'll be able to cash in. Okay, on the flip side, you can get the option to sell the house for $500,000, and this is like shorting. The goal is that the house is worth like $100,000, and you can cash in on the decrease in value. Okay, so what happens if if you know something big is going to happen? So what if you go ahead and buy the calls, which are the contracts to the long side? That means you're buying the options contract with bullish sentiment that the house value is going to increase, and then you get the puts to the short side with the sentiment that the house is going to decrease in value. So now you're holding contracts on both sides. So if the house shoots up in value, you're going to make money on the calls, and the puts will expire worthless. But you'll have made enough money on the calls to cover that loss. And on the flip side, if the house drops in value, you'll make money on the puts, and the calls will expire worthless, right? Sounds simple. So that's called a straddle. Now, the problem is, say this event we know that there's an event. Let's say the event happens and you thought the house was definitely going to go either go up to $1 million or drop to zero. Okay. The event happens, and the next day say, hey, guess what? The house is still worth $500,000. You lose on both sides. Okay, because you probably would have had to pay a higher premium to account for that higher level of volatility. But let's say you paid 5,000 for both options. Okay, so now you've lost on both sides, and that's the risk that comes with trading options around earnings time. You can get into a strangled position because you're hoping there's going to be a huge move. If there's no huge move, you lose on both sides. Okay, so volatility, those higher volatility levels can be both a blessing and a curse at times. It's just sometimes they really work in our favor, and other times they don't. In general, though, our strategy is not to take trades going into option or going into earnings. That's not a strategy that we're going to specifically that we're looking at. We're looking at a little bit different setups. So we're not dealing with volatility in the level that you would if a stock was about to report earnings. Okay. Now, let's talk about the rate of change or delta. So, as I was saying, if you're buying strike prices that are very far outside the money, so in the case of the house, that could be, say, 700, 800,000 strike price. Okay, those small fluctuations in value are going to have very little impact on the premium value. Okay, the value of the options contract. So you're going to see very little change in the price, which means you have a very low delta. Okay, now high delta, those are going to be when you're very close or even in the money, because any change in the value of stock is going to almost immediately impact the value of the options contract, right? They're at the money, so the strike price of 500,000, 505, 510, those are going to have the highest delta, while the ones furthest out of the money are going to have the lowest until they basically have a zero delta. And that's the point where it's zero. Your only hope of getting a profit is, some Hail Mary. The stock is bought out for 3 times its trading price. Right? That's the only time you're going to make money. Now, there are traders that will take speculative positions if you know they understand the industry, or they like the company, and that will basically be the only purpose of strikes that are really, really far out of the money. But I don't trade like that. I'm looking at strikes basically at the money. So in the case of the house, I'd probably look at 500 or 505 calls, maybe 495 puts. So we'd be looking right at the money, or just a fraction of a small percentage outside of the money. Okay, that way we would have a higher delta, which means we would have more opportunity for quick profits. Um, but the difference, between calls and puts, uh, if you're an options trader, if you're trading calls or puts, this is a lot like trading long or short. Okay, calls are longs and puts are shorts. Okay, so if you're just buying calls, you're basically expecting the price of the asset to go up in value. If you're buying puts, you're expecting the prices to go down in value. In both cases, you're buying, you're purchasing these options contracts. The difference between the calls and the puts is that the the uh, the difference, the puts is that the puts, the options contract is with the option to short the stock at a later date, whereas with the calls, the option is to buy at the later date. Okay, I know it can be a little confusing, but when we short a stock, we're selling it and then buying it back at a later, when it's hopefully lost some of its value. Um, so when we're getting puts, we're buying the puts because we're buying the option to sell um, something later. So we buy the option to sell it later. Okay. We don't have to exercise that option. It's just our right if we want to, but we don't have to. Okay. So calls are the equivalent of going long, and puts are the equivalent of going short. There are a lot of traders, and for the most part, this is what I do. Um, I buy calls when I think the stock is going to go up, and I buy puts when I think the stock is going to go down. So I'm not I'm not doing complex options trades like strangles and straddles. Those are more complex. Okay, you can go on. You can just Google it, do a bit of research yourself if you want to. There's a lot of complex option strategies. I'm not going to go into that this lesson. I'm sure there are some tremendously successful options traders that use just complex option strategies, but the strategy that I'm going to discuss here, because my main strategy is equities, not options. So I'm just going to go over the basics here. So that the strategy that I use, it's very simple. I'm just focusing on using options instead of buying the stock itself, and that's only because it reduces the exposure in the market. Okay. Now I'll get a little bit more into that in a second, but um, so I just want to explain puts further. Um, Puts, I think I've already explained pretty well what it means. It's the option to go ahead and sell the house at $500,000. Okay, so it's kind of odd that you would. It doesn't make a lot of sense in the example of a house, but in the example with stocks, you're purchasing the ability to short that stock later. So let's say I'm going to give you the ability to short Apple at $100, and you have until December 31st to exercise that option. If Apple drops to $50, you're going to want to go ahead and exercise that option. Okay, you're going to want to sell short Apple for $100 because you're going to make a ton of money, right? If you didn't have the money to buy the shares, then you could instead go ahead and sell that options contract on the open market. Okay. So my approach with options is just consider them long and short, not to use the complex option trades, just to use them long and short. Okay. So for me, the advantages of using options is that we're putting much less capital at risk. So in the case of the house, you're getting the options to buy a $500,000 house, and all you have to do is put up $1,000, right? So with option contracts, it's the same sort of thing. We'll have the option to say short a particular stock. Let's XY short XYZ or buy XYZ long, and we might pay, I don't know, $3 per contract. Okay, so we might have a total investment of $3,000, but XYZ is, geez, right now it's about $100. So we're putting in $3,000 for the potential to double it or triple it. If you have if you wanted to have that same type of return with outright stock, you'd probably have to buy, 400,000 shares. Okay, 400 shares, 400,000, not 400,000 shares, $400,000 worth of stock. Sorry. So 4,000 shares, and that would be a tremendous amount of capital to put at risk. So we can put much less capital at risk, and this is the advantage for traders with smaller accounts, right? You want to take swing trade positions. You want to be in the market, but you don't have a $500,000 account. You don't have that buying power. Even with leverage, you don't have that buying power in your account to trade with. So options gives us the leverage to be able to do that. Okay, utilizing this leverage in a responsible way is what's going to separate the successful traders from those that just lose money. You know, the ones that more gamble mentality that we discussed earlier in the course. So when I'm trading options in general, my stop is going to be at a 50% loss. Okay, that's a huge stop in terms of capital, right? If I'm risking half of my position, I mean, what I'm saying is if I bought $100,000 worth of Apple, I would never risk half of that, right? I'd be risking like $500 or maybe $1,000. But with options, it's different. You have to assume that if they don't go the right way, if they go the wrong way, you could lose half your money. You can do it. You can lose half your money pretty quickly. Okay, and so you don't want to put in more than you can afford to lose, really. So you might want to put in only, let's say, $1,000, and your stop is 500, uh, a 500 loss, right? If you lose half, you're down 500. You take the loss. On the flip side, your target is to double your money. Okay, so you're 100% profit target with a 50% loss. That's a 2-to-1 profit loss ratio. Okay, so losing a 2-to-1 profit loss ratio, we can be right 50% of the time and still make money. The same risk management principles apply to options as they do to regular trading of equities. Okay, now we had an options trade. I did an options trade recently, okay, and I'll talk about that in a second. And what I really want to do first is talk about the risk. Okay, so let's look at the risk around options. So as I said, there's a very real possibility that an options goes the wrong way and you lose 50, even 75% of the money you put in. And it's not uncommon to see the spread between the bid and the ask be as much as 10%. Okay, it's much bigger than you would see in most stocks. Okay, uh, there are stocks that can have an options chain where it's 50 cents on the bid and $1 on the ask, right? As soon as you get in, you're basically a 50% loss, a 50-cent loss. Okay. There are options that trade 5 cents on the bid and 10 cents on the ask. Okay. So in that example again, it's a 50% loss as soon as you get in, just because of the spread. You know, the a 10% spread would actually be fairly tight spread in options usually. They don't trade that tightly. Some options do have a lot of volume and are very actively traded. Those are going to be in the predominantly in the high flow big companies like Apple or Priceline, etc., or Google. Those are a few that are going to be traded fairly actively. Day traders and short-term swing traders are going to be trading them on a day-to-day basis. But other options on stocks that are less commonly traded are going to have such light volume that there's just not the liquidity in the market to create a tight spread. So in low float stocks, we see big spreads. Okay, so this is the same thing. We there's not a lot of activity, so we see bigger spread. But for me, the value is that I can be in the market with the potential to double my money. So my goal is $1,000. If my goal is $1,000 a day profit, so if I take a couple of swing trades and options, and I'm putting $1,000 into each of them, and my goal is to double that. So to make $1,000 on each trade, and that will be my target, then I can actually do pretty well trading options, and I can hold overnight, and I could be in the market, but I'm not risking a tremendous amount of money. If there's a 10% drop overnight, I'm not going to lose $10,000, right? If there's a 10% pop overnight, my $1,000 option contract could be worth $8,000. Okay. Whereas if I was holding out, right, my percentage value would increase. My percentage value increase will be much lower. So we're going to see a lot more volatility in the options. But if we're using this combination with the right trading strategy, we can harness that volatility exactly where we expect it to come in and where we expect it to go. Calls and puts have no effect on the price of the stock. Just remember that. The calls and puts are based on the price of the stock. So the price of the stock affects the price of the calls and the puts. Okay? Just because there are tons of people buying calls and puts does not mean the price is going to go up or go down. Unless the price of the stock goes up or goes down. But if the price of the underlying asset goes up, then the calls and puts will move with them. Okay. Now let's look at an options chain. This is what an options chain looks like. Okay. Now on this one, this is Apple. When you pull up the options chain here, this is typically what it's going to look like. Okay. On the left side, you'll have your calls, and on the right side, you'll have your puts. Okay. So calls are calls. Where's my cursor? Calls here and puts here. Okay. Calls are going to be long buying, and puts are effectively going to be short buying. Okay, like we covered a couple of slides ago. Okay, so the strikes, you can choose how many strikes you want to display. So here we've got 14 strikes at any given moment in time, and they're always going to be at the money, then strikes away from it. Okay, If you say 14 strikes, you'll see 14 strike prices here. So this is for Apple. Okay, so you'll see 14 strike prices here. And at the time, we can see that had a strike price of 116, or the current trading price of this was well 100 115.48 or whatever it was. Okay, so the strike right here, 116. So we've got the strike down here, 116, which is the current price is in between 115 and 116. So we've got 116. Okay, you can see it's out of the money is grey, and in the money is black. So on in the money, out of the money. Okay. So this is the current price here. And if you're looking at calls, anything over here it's actually in the money, and anything is above the strike price. And this is the other way around in the puts. Okay, so if we're looking at right here is where they flip. Now, if you look at the value of the calls are 109, as you can see there. The calls at 109 are currently $6. You see that? 650, 655 at 109. And at 122 are currently 3 cents. Okay. So why is that? Well, the calls at 109 are already $6 in the money, because 115 is the current price. So if you buy the 109 calls, you're buying the right to purchase the stock at $109. So the inherent value is that stock is already trading at 115. You already have $6 of value, right? See, that's really good value. Okay, so if you have very high delta, you have very high delta, the stock's going to be very reactive to the price. The Vega on this is you can look at the Vega here. So the Vega on this is low. Okay, and the time decay is not much of an issue. Okay, so very little in terms of the time decay as well. So you can get this, and you basically, there's not really much of a trade in it, because it's already in the money. So what we would say, all right, is we think Apple's going to trade at 118. So if we get into this strike price at 118, so 118 here is 19 cents. Okay. So let's say, actually, let's go with the 119. Let's say we want what 119, because it's a nice number. It's a round number. It's at 10 cents. Okay. We get the 119s at 10 cents. And let's say this goes up to 125. Okay. This is going to go from six. This is going to go from 10 cents up to 55 cents. So think about that percentage return, right? That's massive. So that's the appeal of options. You could get this, and you could buy this strike price 10 cents. Those are the calls. If this goes up to 125, you're going to make a ton of money based on, well, obviously based on how much you put in. Let's say you put in 500 in it, and it goes up that much. You're going to make a really nice return. Okay. Now, same with the puts. Okay. You buy the 110 puts at 5 cents. Okay, let's have a look at the 110 at 5 cents here. Okay, so you buy, and it drops to, I don't know, $100. These are going to be worth, a ton of money, a lot of money. Okay, $10 each. So if you're anticipating a big move in the stock, you're going to make a much higher percentage return by purchasing options. Now, occasionally, we'll see something like, let's say we saw someone come in here and buy 5,000 contracts here on the ask, and 5,000 option contracts. Let's say 10 minutes later, the stock price drops by 20. Okay. So the person that did that almost definitely had some insider information. And SCC is probably going to investigate who placed that trade because that's highly suspicious, right? If you want to maximize your profit and you know something, you would take options because, look, this would go um, from 5 cents at 110, go from 5 cents. I mean, there are times when we've seen orders that go through like that, and they report that. This was a $8 million profit, and it's like, okay, who knew that Apple was going to drop that quickly? Someone knew it, and then they usually halt the trade or reverse it or investigate it or whatever. Okay. But even if you just have it, if you have the inclination that this is a pharmaceutical stock and other pharmaceutical stocks have been bought out, I'm just going to throw $100 at this, that maybe they got bought out as well. So I'm just going to go far out of the money on this current price. It's going to have a low delta. The current price changes aren't really going to make a difference. This is just it's a lottery ticket. It's a punt. It's a big punt downfield. Okay, that's basically what it is. That's what some people call these. They're just lottery tickets. Okay, when you go far outside the money like this, it's a lottery ticket. Okay, because the odds are that it'll expire worthless. Okay, now that there's always that 1 in a million chance that you'll get the buy at, and the thing will be worth, you get the buy right, and the thing will be worth 20,000% or something. Okay, if we take Indonesian Energy on Friday, for example. Now, if someone was playing options with that on Friday, and as the market opened, they bought. Let's say it cost them. It opened at $20, I think it was, on Friday. And if somebody said, okay, well, I'm going to go $10 out because that's a good one. I'm going to buy longs. I'm going to buy calls. And I'm going to buy 10 contracts. Each one of those contracts is worth, you get the option to buy 100 shares, okay? So I'm going to buy 10 contracts, and each one of those contracts is worth, say, $10, okay? So, or at 20 cents, it might have been, let's say it's a dollar each. Let's say it's a dollar each, that rather than half the actual value. So for 10 of those, they're putting $1,000 into the options contracts because they're buying 10 contracts, which is times 100. That's how many shares each contract goes. and they're buying 10 of those, and it's $1 each. So we're looking at, it's $1,000 they're putting into it. Okay. Now on Friday, close of business before close of business, the price went up to $48. So that's a move of 28. It was 250% on over the previous day's closing price, but it's a $28 move. So when we actually put that into consideration, and let's just say you don't hold it, you just hold it for $20 of that move. Okay, so you get $20 on each one of those. So you've now got 1,000, the ability to buy 1,000 shares. You bought 10 contracts, 100 shares per contract, and each one of those, it's moved up $20. Okay, you bought it when you bought it when it was $20. It's moved up $20, but your strike price was $30. So you've captured a $10 move in that time. You sell it before it reaches 48. So you sell it at 40. So you captured $10. So you've got made out of that $1,000 that you put in, you've then made $10,000. That's $1 per share. That's it's a huge win. It's a great win, and it just gives you an advantage of doing it that way. Okay, now buying versus selling options. I started talking about this earlier in the lesson, and it's really important that you understand this. Okay, as a buyer, we have options, but as a seller, as a buyer, we have options, but as we have rights. Okay, but as a seller, you have obligations. There's a difference. There's a slight difference. You can still make money both ways, um, but there's a difference. You can decide to be a seller of options, which means you're actually writing the options contract. But if someone decides to execute that contract, you're on the hook, right? You have to execute it. So you're obligated as writers of options. That's where you have a tremendous amount of risk. Okay. So if you wrote the option and the stock skyrockets up, um, your risk is potentially unlimited. Whereas if we put 500 to if we put $500 in to buy, the calls, and this is the stock tanks, then all we lose is $500. That's all we put in, so that's all we lose. Okay, our risk is capped. Our risk is limited. And managing risk is the most important thing that we can do as traders. Keep coming back to risk mitigation, risk management strategy. Okay, so my strategy, my trading strategy with options is to find a stock that has a big potential range. Okay, so the big potential range, and I just mentioned there about Indonesian Energy last Friday. It was the only stock pre-market that was gapping with any level of volume. Out of the gates, it remained for the best part of an hour the only stock. That's where all the volume was. So of course, it had a big potential range, and it ended up moving up 250% on the day. Okay, now I'm not going to trade. I'm not going to trade options on a stock that's sideways, right? I'm looking for stocks that are moving, that are moving potentially quickly in a large range. So the setup for me that's the easiest to trade and apply is going to be the bottom bounce and or the top reversal strategy. Now we've gone over those in the previous lessons. If you're unsure about those, the last lesson with regards to the advanced technical indicators and also the lesson on trading strategies, intraday trading strategies, Go back over that and look at the bottom bounce and the top reversals. Okay, so I believe these are the easiest ones to trade with options for me, especially when it includes the potential for gap fill. Okay, and we'll look at some examples on the daily chart, but that for me is really the ultimate setup. You know, and I'm not a big swing trader. I'm not a big options trader, but this is one of the areas where swing trading options can be quite profitable. But what we need is a stock that has a lot of range, usually a very recent spike down or spike up, the potential for gap fill, okay, and it's got to be relatively liquid. The options trading. Some stocks will have options, but the spread will be so bad that we can't take it. Even if the chart setup is amazing, when we pull up the options chain, okay, let's go back to the options chain. Even when we pull up the options chain, um, we're going to see the spreads. So on this one, the spreads are like, you know, in between here, so they're a penny or whatever, 4 or 5 or 9, 10. So they're like 1 cent spreads. Okay. But then again, Apple is a very heavily traded stock. Um, you, you, if you look at, I mean, let's face it, look at the volume here. We're going to 25 million shares traded. Okay. So 20, 30, 40,000 shares traded on a daily for Apple. It's normal. Okay, a lot of volume in Apple. Okay, so when we have a stock that has very heavy volume, and I talk about Indonesian Energy again from last Friday. That was like 20, 25, 30,000 shares traded across the day. Um, there's a high likelihood that there'll be heavy volume in options activity too. Okay, if it does trade options, some stock doesn't have options. You can't trade options on all of them. Okay, so some don't have it. I don't think Indonesian Energy on Friday had it. I think I did have a look, but it didn't have. But just as an example, um, uh, which is why sometimes those big volatile stocks, you know, a recent IPO, for example, it's difficult to get options on a recent IPO. So that's just an example. Okay, so some don't have it, but those that do, that are traded actively and are going to have a tight spread, then if we find one that's the perfect setup, but has a bad spread, well, there's nothing we can do about it. We're just not going to take the trade. Okay. So we're going to look for stocks that are at extremes. Think about the rubber band analogy again. We're going to look for, we're going to be looking for stocks that are good setups for the bottom bounce or top reversal. Okay, it's going to be a good approach for trading options is look for those stocks at the extremes. So the really taut, stretched rubber band that we talked about previously. Okay, super extended, and then look for the snapback. Okay, that's the setup that I like the best if I'm trading options, because those are the stocks that are so overextended on the daily chart that when we start to get that reversal, there's a good chance it's going to be very quick and it's going to be well defined, and we'll be able to get a really nice percentage return, okay, without putting a ton of capital at risk. So if a stock has been tanking and we want to do a bottom bounce on it, you know, you know how comfortable am I going to be buying this stock to hold it overnight for the next what, 5 days or a week or something. I'm not. I'm not going to feel comfortable. If the stock's been selling off for a reason, think about Facebook just recently sold off and is still selling off. Okay, I'm trying to guess the reversal. But what if the stock is halted? What if they file for bankruptcy? What if I'm going to put $50,000 of cash into something and it's going to really require me to do, you know, I'm going to have to do a lot of research on something if I'm going to put $50,000 worth of cash into a stock and start holding it for days on end. Okay. Whereas with options trading, for me, it's because there's less risk involved. I can focus more on what I'm good at, which is finding the good chart patterns. Okay, and for me, it's just a lower stress way of staying in the market for a longer period of time. Okay, that's what I get from options. So um, with that said, I know there's a lot to take in on into account on options. There's a lot of jargon, what I would call jargon, in terms of the terminology and the Greek. Um, there are some more complex options trading strategies that you can employ. I've not gone over them. I touched on the straddle and the strangle. But what I would say is if you've got any questions that you want me to ask, I'm not a regular options or swing trader. You know um, where I get what 95 or more of percent of my profits come from is day trading, high volatile, high volume, or relatively high volume stocks and equities. Okay, but I will occasionally trade options, and this lesson was really to give you a basic understanding of options. If you do want more, I can go into more detail. I can either get on a call with you on a one-to-one basis, or by all means, do your own research. And if you've got any questions, come back to me. Drop me a line in the either in an email or leave a question on this lesson. And I'm a little sad to say that concludes the end of this course. So if you do have any questions on the course as a whole, drop me an email, get in touch. Whilst you're going through this in the next 3 months, make sure to schedule some one-to-one time with me. So, for mentorship, everybody gets at least an hour's direct one-to-one coaching with me as part of this course. So you reach out to me directly, and we'll get that. If you haven't already, we'll get that scheduled, and we'll have that discussion, and then hopefully this course has given you everything that you need to start, continue, and grow into a profitable day trader. Good luck, happy trading, and keep on hustling. Thank you very much.